NVIDIA may be America's top performing stock after more than doubling this year alone. But if you're holding NVIDIA or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see Mark Chaikin's new AI prediction first. Mark is a regular in many news outlets from Fox Business to CNBC and built the stock indicator Wall Street uses to find winning stocks. His award-winning system flashed buy on Tesla before it climbed 335%, Moderna before it climbed 300%, and Riot Blockchain before it climbed 10,090%. It also found NVIDIA at the start of 2023 before its massive bull run. But right now, Mark is stepping forward to warn people to stay away from NVIDIA. My system has indicated that NVIDIA is no longer the best stock to buy to profit from AI, is what Mark says. In fact, it just flashed buy on a totally different AI stock. And today, he'd like to hand you the name and ticker symbol of his number one AI stock to buy right now. For a limited time, you can get this information for free at www.aifrenzy23.com. Again, that's aifrenzy23.com for a free copy of his new report.
Hey, welcome to Making Money. This is Matt McCall. We're here at Future Proof out in Huntington Beach. One of my good friends I ran into, Brendan Ahern, CIO of KraneShares. Got him to sit down with us. Brendan, you're the expert of all things, everything when it comes to China. And I don't think I've seen you in person since we were in China. What was that, maybe 4 years ago, I think. What a great trip that was. And we were just talking about how good the food was over there. But, you know, China, the last, I guess, couple of years, right, has greatly underperformed the U.S. markets. And there's been such tensions between the governments of the two, at least that's what the media tells us. Where do we stand now? Because the valuations of some of these Chinese stocks are sitting at multi-year lows.
I mean, the asset class has been eviscerated. I think that's the only word that, provides the emotional extent. And, we'll get into some of the, diplomatic, some of the regulatory that have weighed, but I think stepping back big picture, we forget the exceptionalism of U.S. equities over the last 14 years, that the S&P 500 is up about 800% since the global financial crisis low in March of 2009. Non-U.S. equities, so MSCI All Country World ex-U.S. is up 250%.
Wow.
And then emerging markets, MSCI Emerging is up about 200%, MSCI China up about 150. So this is less about China being out of favor. Everything but U.S. stocks has been out of favor.
So you're saying it's more than just China. It's everything outside the U.S. Okay.
That, obviously the U.S. economy has done very well over the last 14 years. You have a huge tailwind, strong dollar, which is a huge, headwind for non-U.S. equity investors. And I think, having bounced around the globe, meeting with institutional investors over the last year, the one common narrative is that they're all overweight U.S. stocks. That, if you put yourself in the shoes of a CIO of a, foundation, endowment, an insurance company, pension, a financial advisor, that's 14 years. That equals 56 quarterly investment committee meetings, client meetings, board meetings, for explaining why you hold something that always detracts from performance. That the more you've diversified, and Harry Markowitz would be rolling in his grave, but the more you diversify, the worse you've done. The more you've moved away from U.S. And so what happens to that non-U.S. equity position? And now I think for a lot of it, it's gone.
But what will be that catalyst? Because at some point, it's going to be, revert back to the mean, where the ex-U.S. are going to outperform at some point. This doesn't go on forever. Are they going to be late to the game when they finally do that? Like when they sit down and have these meetings, right, every quarter, who's going to walk in a room and be that guy or that woman and say, hey, we need to start looking outside the U.S.?
Oh, the person who said, okay, this is 50 straight quarters, let's, they got fired.
Yeah, exactly.
They're
That's
gone.
what I mean. Like, who's going to do that?
So I think, for us in the China internet space, obviously KWeb's our flagship fund, so we're highly biased and self-serving, but it's the valuation argument is getting to a point of where I was like, it's literally laughable. So with Amazon's market cap, you can buy all 31 companies in KWeb and have $200 billion in cash left over. If you take Alphabet's market cap, you can buy all 31 companies in KWeb and have $500 billion in market cap. So we're talking about the purchasing power of 1.4 billion people is not worth anywhere near as much as some of the largest U.S. companies. Apple's market cap is larger than all 700 Chinese companies in MSCI China.
That's mind blowing. If you had told me that, obviously I believe you. I never would have. If I read that, I would not have believed it.
It's just where you have this evisceration of non-U.S. and then you throw onto it the China tensions, where U.S.-China diplomatic. You have the holding foreign this potential ADR delisting that's been kind of pushed off. Just it's no one owns this stuff, and the one thing that we've noticed that is that short volume in Hong Kong for 10 years, from 2011 to 2021, averaged 12% of total turnover, and it's doubled.
Oh, wow.
It's gone, or I'm sorry, it's up 50%. It's averaging around 18%. You literally had over 10 years, more than 2,000 trading days. You had 0 trading days over that decade from 2011 to where short turnover never exceeded 20%. And we're up to about 70 days in the last 2 years alone. So if you're a short manager, you're a hedge fund, and no one owns this, why wouldn't you just pound it lower?
Yeah.
Because the cavalry's never coming. That buyer, there's no buyer of last resort, so you just pound it lower. And so we think this is just built on itself. And there are, the one buyer are the companies themselves.
Okay.
All of the
stocks.
Buying back.
Yeah.
They're all buying back stock. If it's Tencent, Alibaba, Baidu, JD, they're the only real buyer out there.
So, obviously China's pushing AI as much as any US company, right? Especially their government's been behind it for a long time. So eventually they have to, I shouldn't say have to, I would assume they have to be valued at some level that is what they're really truly valued at, right? But you look at the markets and cheap stocks get cheaper all the time.
Oh yeah.
So again, I think I go back to what do you think the catalyst will be? Will it be better relations between the two countries that gets people positive again? Or, you see stories all the time where firms are saying we're not investing in China at all. There's the ARK funds who did that? They came out? To me, that's crazy. It's the second largest economy in the world. It's one of the fastest growing economies. How can you just eliminate that? That blows my mind.
Yes, I mean, there are issues without question, and it takes two to tango, so we're not pointing, but it's not going anywhere, and I think if the Fed pauses, and that's a debate, when or if, and the dollar is due to roll over, you have a potential for this budget issue at the end of this month. No one's really talking about, can the two sides come together? So at some point, you'd say that this tailwind that's helped, if it's U.S. recession, the baton gets handed. And most of us would say the next decade will look like the last decade. But I always say, well, what about the decade before last? That was the lost decade for U.S. equities, and I'm not rooting for that. I'm just saying, the Chinese consumer will come back, and we think we're really well positioned, and we need these positive catalysts.
So let me ask you, say the U.S., I think majority of people on Wall Street, analysts, believe the U.S. is going to be kind of flat at best for the next couple of years, especially when it comes to the economy, everything. I'm a little more optimistic, but neither here nor there. Say it does go flatter. We do have kind of that lost 5 years, let's say. Will China be able, and emerging markets, be able to do well if the U.S., because you'll see money flow out, or will there be a bit of a contagion that if the U.S. slows down, it affects everything else?
Yeah, I mean, in the short run, stocks are beta, and they're highly correlated. So if you have a budget crisis, if you have a U.S. recession, to say emerging markets, is going to be immune, I think is a fallacy. But I think they will not. They won't, in theory, they might not fall as much because they're already at these distressed valuation levels. And, the hard thing is going into 2023, you'd be like, the U.S. faces, high valuations, quantitative tightening, M2 is shrinking, probability of recession very high. China and a lot of EM were doing the opposite. China, low inflation, low valuations, quantitative easing, interest rates are dropping. And so I think you're starting to see in the EM world, some of the central banks in the emerging world are starting to cut rates. So I think the situation will be kind of forced on investors to say, I just think about myself. I've never bought a certificate of deposit in my life. And I'm like, 5%? Like, that money I would have put in the U.S. stock market, and I'm putting it into CDs.
Yeah.
And I just think there's valuation disparity so wide in EM. It's going to force people to look at some of these neglected opportunities.
So within China, obviously there's been a lot of talk about the real estate sector as of late.
Yeah.
What's your take on that?
So the problem is it's multifaceted.
Okay.
So one is as distressed players like Evergrande, Country Garden, they're not going away.
Okay.
In that the problems aren't going away, but the companies are clearly implicitly backed. They're not going to allow China's Lehman moment. It's so much government scrutiny to prevent the first domino from going.
Okay.
So they're going to prop those companies up. The problem with the distressed players is their issues have weighed on property prices. 2/3 of Chinese household wealth is in housing investments.
Okay.
So you put yourselves in the shoes of a Chinese consumer. If real estate prices have dropped, it's like it's gonna affect your consumption trends.
Tighten the wallet, right? Yeah.
Tighten the wallet and throw in the scar tissue of zero COVID policy.
Yeah.
Very tepid consumer. And that's why you're seeing all of these Chinese cities backing away from home purchase restrictions.
Okay.
They lowered the mortgage rate. They're going to try to get those property prices back up to help with consumer confidence.
See, that makes perfect sense. Nobody's said that. Thank you for explaining it that way. Because you always think, well, the government's going to back them up. But what was going on? If they knew the government was going to back up these companies, why were they still falling? Why was it, the consumer still? But that makes so much sense when, it's a mindset, right?
Yeah.
The mindset is that.
And the government doesn't want to incentivize poor management.
Yeah.
If you just bail them out, you bail out a.
Not like the United States, we do that.
Yeah,
all the
we
time.
never do that. But in theory, if you had a bank that couldn't match its assets and liabilities, it gets bailed out. Well, the next bank's gonna say, well, the cavalry is always going to come.
Exactly.
And the Chinese government said we're not going to incentivize bad corporate management, so those companies will pay for their sins.
Okay.
I mean, they will cease to exist.
Okay.
It's just they have to allow them to muddle through to prevent things from spiraling out of control.
So the next question would be, do you see any investment opportunities in the real estate area in China?
So I'd be careful, some of these stocks, really move.
Okay.
You have individual names in Hong Kong going up and down 25%.
Okay.
Where we're more cautious on the stocks is in order to bolster the balance sheet, they're going to issue more stock. So we would lean more toward the bonds because the bonds we think will get paid and they're selling at very distressed levels. So there are ways to play this Asia dollar bond, which is, again, it's another asset class that's literally been left for dead.
Do you have a ETF that does that?
We do. We have KHYB is a Asia dollar high yield bond. So it's a very high yield. It almost moves like an equity. So you don't come out of very conservative fixed income. This comes out of an aggressive equity allocation.
Yeah.
And I think you can get paid on these bonds because if they're at 10 cents on the dollar, they're not going back to par.
Sure.
But if they just get to 25, that's a double.
Yeah.
So that ETF is actually actively managed through a sub-advisor, Nikko Asset Management, in Asia. So they're doing this bottom up, and they're favoring some of the consumer plays, like the McCall bonds. They've been tossed out. People say, oh, that's, what difference is a Macau casino from, a Chinese real estate company? So we do think there's some interesting opportunities.
Man, that has me excited. That idea, because I'm always looking for different ideas, and those are opportunities that don't come around that often, right?
No.
That's something where, and nobody's talking about it, which makes it even more exciting.
You have this Asia dollar bond market was 50% China, 25% Chinese real estate developers 3 years ago. You fast forward, those numbers are chopped literally in half.
Wow.
You had, in Asia, these were called high yield bond funds.
Yeah.
And you literally have mutual fund families just shutting down these funds because they're just like, oh my gosh, like we lost 50% in a fixed income fund.
Yeah.
And so they're literally just giving the bonds away.
I'm going to look into that. I like that idea.
It's an interesting play.
So outside of China, I know KraneShares, you really concentrate in China. Is there any other areas, countries, regions, world in your travels? You mentioned you've been in South America, Middle East, Asia recently, that you see opportunities in emerging markets?
Well, I think, one, just traveling, you do see that the rest of the world has a little bit of a different perspective on China. That when you go to South America, many of those countries do more trade with China than the United States. Just, you saw when President Xi of China went to Saudi Arabia. I mean, they literally rolled out the red carpet. This is like your number one clients in town. So some of the perspective from a media narrative can be a little bit different, but I think in general, areas we continue to see opportunities in global electric vehicles. The rest of the world, you can't import an EV into the U.S. without paying these massive. The rest of the world is like, we'll take them.
Yeah.
So we think electric vehicles will continue to do well, and that's just not a China thing. Certainly, clean technology is not going away. And we're starting to see a rebound. We've kind of pioneered these carbon credit allowances, which in Europe, they're trying to disincentivize polluting by raising the price of carbon. And that market has started to rebound a bit as Europe's economy kind of recovers or gets used to what's unfortunately playing out in the Ukraine.
I love it. I mean, you're always a wealth of knowledge when it comes to China. And I don't want to say I'm a China bull, but I always look for opportunity. And I got to tell you right now, some of these stocks, whether it be Alibaba or Tencent, it's tough not to buy them, but it's tough to buy them. I kind of go, both ways with that.
Well, that's the, and part of me is just the uncomfortableness.
Yes.
That, that's not the, there is no easy trade, and just think about our old friend Steve Sugarud. Used to say unloved, underowned, and we just kind of got to get this uptrend going. And I'm like, oh, those are Steve's old mantra, and we would check those boxes. And I certainly think the market does what's least anticipated, and just totally random. I was reading an Asia strategist who spent his career in China and Asia. It was like, oh, this EMX China phenomenon, China's not investable. I was like, man, this guy's throwing in the towel on his career.
Wow.
And I was like, that makes me bullish. It sounds crazy, but if he's throwing in the towel, I'm like, that's what a great contrarian.
I got to tell you, we're sitting here talking, you and I, we have more of a global perspective when it comes to investing. But most people, even here at the conference, I think are probably really focused on the U.S. And again, that makes me extremely bullish on China long term. I mean, could some of these stocks pull back another 20%? I wouldn't be surprised. But I'm looking at 7 to 10 year investment. I think I'm gonna do pretty good in some of these big names, or better yet, just buy one of your ETFs and not have to pick the one name. For most investors, a little too aggressive.
It can be hard, and just what's happening with Alibaba recently, where one of their senior people is stepping down. The rest of the market is up, and Baba's off. And I just think about there was this great quote about Jeff Bezos was being interviewed, and the interviewer was like, well, what's the new technology that's going to impact the world in the next 10 years? And he was like, I don't have any clue. But he's like, I do think about what's not going to change in the next 10 years. It's people want cheap stuff delivered fast and they're inexpensive, and that's my view of China is it's not going away. And in 10 years they will be larger. I mean, there'll be fits and starts, and I do think we get the sense the diplomatic situation has stabilized, and that's people will say, well, I don't want to hold China. I'm like, well, let's sell your Apple, your Tesla, your ExxonMobil, your Starbucks, your McDonald's. I mean, you have a lot of implied China exposure through U.S. multinationals, and we just think there's an opportunity on the explicit China side.
I think there is too, man. And it's always great to see you. Great to sit down.
It's great to see you, man.
Yeah. And hopefully we'll do another China trip again soon. Because I know you're there all the time, but I'd like to get back over there.
Yeah. It's and that's been I think part of the problem is you had a stressed relationship and you go through a really stressful COVID. So there were COVID babies. Some relationships got a lot tighter, but there were COVID divorces. And I just think. Now that you're starting to see diplomatically some travel back and forth, it should help stabilize.
I'm optimistic. I mean, I think I've always said China needs us and we need them. The people who say that we don't need them they're completely uneducated on the whole topic, in my opinion. So, but we'll leave it there and optimistic that we think things are going to get better.
Most definitely.
But thank you so much,
Thank
Brandon.
you, Matt. Yeah, it's great seeing you. Thank you again.
Again, Brendan Ahern, CIO, KraneShares, good friend of mine, sat down. Please go check it out. If you're interested in China, they put out some of the best research in the entire market. Please go check out their website. But again, from Future Proof, that was Making Money, and I'm Matt McCall.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.